All right, welcome to the weekly meeting. Um, the first one for July. What is it? July the 6th. What's today? July the 5th.
The fifth.
Okay. So I just want to kind of recap this trade and kind of talk you off of a ledge for those of you who are short on EU or GU or whatever. Right? It banged out. We were up. And in this case, in my opinion, we weren't up big, but we were up um 50, 60 pips. And now we're up maybe 11 pips. So it's okay. This trade was never supposed to be a 50 or 60 pip trade. It's going to be hundreds of pips. But back in 2022, at the end of that 2022, uh, I remember me and Leandra specifically talking about this UJ trade setup. Um, and this UJ trade setup, it gave us everything we wanted. I was a lot more inexperienced then with these types of trades, but it pushed down below the low, went into that imbalance. And I think around the 15th or 16th, it took off, right? Um, and I caught a little bit of this trade, but I wasn't like prepared to the level that I needed to be. So the very next year, the setup happened again. And January 2024, I was all over it. I even called it, and a few people in this group took the trade with me. And we got in on January 2nd. I'll never forget it. And that trade caught up, and I had a nice, fat, juicy lot size on that trade. And where is that move? Okay. This is where that trade is. So I had a fat, juicy lot size on this trade, and this trade caught out, right? And like you, Kenyon, um, I was up big, right? Almost 500 pips, maybe 500 pips. Then it came all the way back where it would almost cut me in half. And I hit the panic button. And I got out that trade. Look at where I got out this trade. Look where the trade ended up.
So you stayed in the 6 month trade for like 3 days?
Hey, I don't like your condescending tone.
No,
I think it was,
I'm
listen,
just
I think it was more like 5 days.
I'm just processing the information that's been presented
It,
to me.
it was about 5 days, honestly, because look, one, two, three, four, five. It was either the fifth or sixth day I got out. Yeah. So it was very premature. But the problem is you see your money go way up.
Yep,
And then that pullback cuts your money in half. And it's a psychological nightmare.
it
I mean,
is.
I wasn't prepared for that. You know what I'm saying? And I had heard about it before, but it's different. It's different when it's your account that's going down that dramatically. And then you start second and third guessing yourself, even though clearly the structure is showing you that you broke a high is fully back, right? Um, but I panicked and got this trade. And when I look at this trade, man, I got a snippet of this trade. I should have been re-entering right here. You know what I'm saying?
Yeah, we know that now.
Well, yeah, but it takes you getting burned like that one time. You know how many trades I've lost in this time period that I wouldn't even have to even participate in. You see what I'm
Mhm.
saying? So what I'm trying to say is I get it, man. Like, oh, you second guessing yourself, and we was only 60 pips in.
I thought I was up more than 60.
You're laughing at me. Well, I no, but you laughing at me for holding my trade 5 or 6 days. But you 60 pips in, and you already trying to. Oh, I don't know, man. I'm second guessing it. Well, what I'm trying to tell you is that pullback. is going to happen. The same way that this pullback on this dollar is going to happen. It's going to pull back, and then after that, man, you can get in on the real trade, the other side of that trade, um, and you can just go long on EU or GU, or you can go short on the dollar. Um, and I have a video today that it's a very good video on breaking down the financial situation that we're in as a country. And it's the reason why the market is sending mixed signals. It's the reason why uh, Trump is behaving like a 3-year-old, with the tariffs. And it's the reason why your boy Jerome Powell is behaving like a 3-year-old with interest rates. It's all comedy if you don't understand the underlying issues. And the underlying issues are complex issues. So most of you who hear this video today aren't going to understand um, what's being talked about. And I've watched this video probably 6 times, you know, and I think there are some terms that you're probably going to need to go and Google, uh, because if you don't understand the terms that he's talking about, if you don't understand um, financial speak, then a lot of this information is going to go over your head. So there's a term called fiscal dominance, right? Uh, Fiscal dominance just means that you've spent so much money that whatever your monetary policy is, it's really ineffective, right? So do y'all understand who sets the monetary policy?
It's
Yes, the Fed.
Jerome.
The Fed.
That's right. So that's Jerome Powell's job, is to set the monetary policy for the country. But he has no control over how much the government spends. And we all kind of blame Jerome Powell for raising or lowering the interest rates. But at some point, the government spends so much money that it doesn't matter what he does. It's not going to have the desired effect. Okay, so you have to understand the meaning of fiscal dominance, because there's going to be a section in here where they talk about fiscal dominance. They're going to talk about receipts, right? My brother is one that he often mentions receipts, in terms of stock market. All right. So you got to understand what bonds are. Do y'all understand what government bonds are? The bond market? Just in case you don't, the bond market is basically a market where the government borrows money from people or hedge funds or other countries, right? They sell bonds, government bonds, or guaranteed government bonds at a certain interest rate, right? And they use those bonds to finance their operations, right? And it's all good, whenever they're fiscally responsible, right? When you it's like if you go to the bank and get a loan. I mean, it's all good if you're going to pay that loan back and you're not just taking that loan and going to party or going to bet in Vegas. But you have to understand that bond market, those people, the government doesn't default on his loans. So even if they have to just go and print money, they're going to pay those loans back. But those bond rates fluctuate, right? They're going to pay you back, but maybe the rate is a lot lower, right? And what they pay you back in paper money is probably going to be worthless by the time you get it back. So you got to understand the bond market, or understand what the bond market is, right? The bond market is where the government gives you an IOU for the actual cash that you give them, right? And for many years, probably since all of you were little kids or born, the major purchaser of government bonds were foreign governments like China, Japan. Uh, but here recently, that's changed. Foreign countries aren't buying government bonds. And really that started uh, right after the pandemic, after we printed like $6 trillion with a T, because those other countries have accountants just like we do. And when they saw us print all that money, then they kind of realized, hey man, they'll never the math ain't mathing. Like that doesn't add up. If you go and borrow $1 million and you're making $30,000 a year, I mean, Ray Charles knows he can see that you're not paying that money back, or it's going to take several lifetimes, like maybe 10 or 15 lifetimes for you to be able to pay that money back. So that's in essence what happened here to us. Other governments aren't buying the math, so they aren't buying the bonds. So they'll talk a little bit about that and who's actually buying the bonds. But this kind of conversation helps you to not only shape your investment strategy, but kind of understand why things are going up. Like, gold just started shooting up for whatever reason. And the thing is, we don't understand all the underlying things that are going on in economics and government spending in the bond markets. We can just see the movement on the charts. And at a certain point, you might get a little bit gun shy about buying or selling something because it's just shooting up in one direction, kind of like we did with gold. But understanding the fundamentals behind the trade or the movement will help you kind of either strengthen your confidence, or it will say, no, I don't want no parts of that trade. But this is the type of video that will help you strengthen your understanding of the fundamentals. And you go on YouTube and there's a million different videos about a crash and about the looming crisis that's going on, in the government. And it can give you a sense of skepticism, or you can always say, man, there's always some kind of a doom and gloom person out there. But what we all should understand is every one of us has spent too much money at some time in our adulthood, right? Whether we were 18 or 19 or whatever the case, we were young adults, and we've all spent too much money on things we shouldn't have spent our money on, whether it was partying, alcohol, drugs, women, men, kids, Christmas, birthdays, whatever. We've overspent, and we had to go get a loan, right? Some of us, have done that several times, right? And some of us had to go get loans from people or lenders that were going to charge us an arm and a leg. And if you've ever been in that situation, then I want you to understand the situation that we're in as a country, the United States. We're that's where we are, right? We've spent too much money. Our deficit is ballooning. Every couple of years, we're up to $37 trillion. So if your deficit is growing by $1 trillion or two every year, we way past health. Like we need a miracle, because in order to get that down, we have to have some type of boom. The GDP has to grow. And why is this important? Because we spend a certain amount of money on defense, right? Then we spend a certain amount of money on entitlements, like Social Security. I don't even know why they call it entitlements. You pay into that, but we have to spend the Social Security money. We have to spend the defense money. and we have to finance our loans. Between those three, that's 120% of what we produce. So what that means is what we produce, we're spending 120% of that. If you spend 120% of your paycheck, then you're 20% in the red on payday. And now you got to go get a loan or something to cover that 20%, and then you need to still have money to eat or, buy fuel or whatever the case may be. So this is kind of where we are as a country and what you need to understand, right? And he's going to bring up some great points. But let me stop talking and give it to your boy Luke. Luke.
Rates, all he was doing is increasing the deficit.
Luke Groman, founder of FFTT, Forest for the Trees. It is so great to see you again, Luke, and it is so wonderful to welcome you back to the show. I feel like it's been way too long, and we always love having you on. Thank you so much for taking the time to join me today.
Well, thanks for having me back on, Julia. It's great to be here.
Well, it's always wonderful to have you, and gosh, last time we had you would have been the very end of 2024, right before we kicked off the 2025 year, and I always say this, I feel like so much has happened, but a lot certainly has happened, and we can take this in so many different directions with everything that's transpiring in the world. But it would be great to just start more of the big picture like we always do, Luke. So let's start there, that big picture, more of that macro view, where we are today, how you're thinking about your outlook as it relates to the economy, markets, and as you know, Luke, you can take all the time you need to set the table when it comes to that big picture, more of that macro view.
Yeah, thanks. It's there's a lot going on. It's a very murky picture. There's a lot of moving parts. And I'll give you an example. As I look across, I'm watching a disconnect over the last 2 years since I think a big moment, if we go back 2 years ago, was when the Bank of Japan lifted the ceiling on 10-year yield, 10-year JGB yield curve control, because the yen has been a major funding currency for years/decades. Ever since the BOJ did that, we have had a correlation between stronger yen means lower 10-year Japanese 10-year bond yields, and a weaker dollar means lower 10-year treasury yields. And those relationships have held for the last 2 years. In the last several months, both of those relationships have broken. In other words, they've diverged. So you're no longer getting a stronger yen driving lower 10-year JGB yields. That's a problem. And you're no longer getting lower dollar driving lower 10-year yields. Also a problem. Because those are the two biggest funding currencies in the world, the yen and the dollar. So there's a lot of people around the world that are short them, and now you're in this situation where it's essentially a signal that the central banks of both of those nations are cornered in some level. They're going to have to make a big choice. They're going to have to choose sacrifice the currency or sacrifice the bond market. If you sacrifice the bond market, you're going to sacrifice the government. In other words, you're going to let rates rise. So that's a problem. You look at the fiscal side.
I just want to cut in here because we talked about that 10-year, I don't know, a couple of weeks ago. Do y'all remember talking about the 10-year? Me showing the 10-year chart?
Yes.
Y'all were asking why.
Yeah.
Yeah. So now y'all kind of understand and why it really didn't make sense. You know what I'm saying? Like, how is the 10-year rising, but the dollar is going down? Now y'all understand why I was confused as to what the disconnect was.
Yeah, it's all making sense now because all making sense.
Wait, I got a question. So you said the dollar goes down, the 10-year is supposed to be going down, but
Yeah, they're supposed to move
what was
together.
confusing you. So with the Bank of Japan, the Japanese currency was going down and their 10-year was going down?
Well, that's how it was working. Like that's how
Okay.
it should work in every country.
Okay.
But now it's not. There's a disconnect. It's a disconnect in a lot of different things. Like uh the dollar and the indices shouldn't be moving together. They should move opposite. The dollar and the 10 years should move together. But there's a disconnect, because uh these central banks are in trouble. That's what he's saying. The central banks are cornered. So there's going to be some decisions that have to be made in the future, here in the near term and the long term. And he's going to tell you, what the decisions are and what he thinks they're going to do. But we just have to wait and see kind of what these decisions are going to be made.
The United States is already at 100% of true interest expense, entitlements plus interest. And now we're talking about ramping up DoD spend. The Doge conversations and the austerity and all this stuff that has disappeared, like the warden in Shawshank Redemption says, like a fart in the wind, right? So you've got this divergence in the two biggest funding currencies, bond markets versus currency, suggesting two major central banks are cornered and they're going to have to make a choice. You've got the fiscal side of the reserve currency issuer, the US, already sort of into full fiscal dominance and just basically hitting full send, as my kids like to say, in terms of let's just spend more on defense. Into those things, you've got physical world constraints that I don't think enough people on Wall Street are paying attention to. Rare earths, for example. We have had the Secretary of State, we've had the Vice President, we've had the President talking about rare earths. So much so that a month ago, Secretary of State Rubio said we can't go to war without these things. And where do we get them all? We get them all from China, at least from a refining basis. So we have a rare earth constraint. We have an electrical grid constraint within all of this. One of the things we never consider costs of our opportunity costs. U.S. electrical generation has not grown in 20 years. While we were off fighting to achieve not really a whole lot in the Middle East, China's grid exploded in terms of their generation capacity, et cetera. While our electrical generation capacity hasn't really risen, which is a problem because now with AI, the grid's the constraint. And so we are constrained in this AI situation. We're also constrained on labor, which is not popular to say or not well understood not that it's popular or not, it's not well understood. In New York, it's not well understood in Washington, where the answer for 25, 30 years has been, we're short, print. You can't print welders. You can't print skilled trades. You can't print engineers. And so not only do we have issues with the grid, issues with rare earths that you can't print, but we have a skilled trade issue, an engineer issue that you can't bring immigration in. This is not a situation you just open the borders and we're going to have a bunch of engineers and welders in 4 months. That's not how it works. It takes years, and we don't have years. So you're running into physical world constraints that can't be printed. And then layering on top of all of that, you have AI that is getting clearer and clearer, going to be a severe deflationary impact to wages and to white collar wages. This discomfort among white collar wages, medical worker wages, is something I recall vividly 20 years ago when China went into the WTO. This is just, we know how this plays out here in the Rust Belt, how AI is going to play out. It's just a question of how long it takes. But China was the first AI. China was the first productivity miracle. It just didn't hit white collar workers. It only hit blue collar workers. So we know how that's going to go, which is I think difficult for the system as it's structured, because ultimately AI doesn't pay taxes and people do. And so the tax base is going to get undercut by AI. The ability to pay mortgages for white collar workers is going to decline. And then you get quickly to a situation where it's sort of deflationary until we need to start printing the money to 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 pay the entitlements, the interest on the debt that we have, the defense bill that is going to rise meaningfully according to NATO and Trump again, even today as we're sitting here talking. So there's a lot of crosswinds, and there's not a lot of easy solutions anymore within those crosswinds. There's all degrees of um, uh, difficulty. Someone's got to take pain, and no one wants to take pain. We're in a society where no one's ever had to take pain in their adult lifetimes, and that's starting to change. So it's a very interesting time. There's a lot of different ways depending on which buttons you push, which issues of those four things I addressed that you try to deal with in terms of order of operations. You can have different outcomes. Most likely outcome to me is going to be some form of, brief deflationary issue followed by sort of, go back to growing the Fed balance sheet again because there's no other option.
Wow, what a great frame up to the conversation as you put out like all these different crosswinds taking place, different outcomes. And as we're recording this on Wednesday, June 25th, I'm just looking at like the headlines are S&P is about to reach new record highs. It sounds to me like there might be like when I hear you talk about this, like it sounds to me like there might be a disconnect in the markets and are folks being complacent then?
No, I think some people are, but I think the bigger meta trade that has been ongoing for years and I think is going to accelerate is get out of government liabilities and get into private liabilities and nobody's liability, right? So I would rather own Apple bonds than U.S. Treasury bonds. All else equal, the same tenor. I would rather own Microsoft bonds and I'd rather own Microsoft and Apple stock than U.S. Treasury bonds. I would rather own gold and Bitcoin relative to both bonds and stocks. And we're seeing, this. So it's a very familiar market action if you've been in emerging markets. It's get out of the government's liabilities and get into something that's going to hold its value in real terms a bit better. But it's something very unfamiliar to most Americans who are still, many of whom are still sitting in 60-40 portfolios, 40% bonds, a big chunk of those government bonds. And you're seeing this divergence already. Where I saw a great chart a couple weeks ago. It showed, all right, so gold prices in dollars started breaking out first. Then gold prices in bonds started breaking out, and now gold prices in dollars, or excuse me, gold prices in stocks have been rising year to date. And so that I think is gonna well, there'll be puts and takes to it, but I think over time that's the meta trade we're watching, which is, we can see the divergence that we were talking about before, which are pretending some version of a disruption or brief crisis. We can see the fiscal side, which is, they're not going to cut off boomers. They're raising defense spending. So they're going to have to slash rates. You've got sort of 4 or 5 different Trump officials begging, literally begging. Lutnick's on Twitter again today, begging for rate cuts, begging.
Yeah.
And why are they begging? They're begging because they know they're cornered. Like, they can't cut the fence. They can't cut entitlements or they'll be voted out unceremoniously. So they got to cut interest to make room in the budget. They know the physical world constraints are what they are. Otherwise, I think that's a big part of the reason we signed, this big AI deal over in the Middle East, where all of a sudden we're going to put a bunch of AI infrastructure in Saudi and UAE. Like, it's always kind of trumpeted as, hey, this is always to our highest and best. And sometimes it is, sometimes it's not. Sometimes it's, holy crap, we spent 20 years fighting the Taliban and to take Afghanistan from them and then give it back to them. And so instead of investing in our grid like China was doing now, we're in this AI contest with China, their words, not mine. And we don't have the grid. Like, there's warnings of brownouts in Middle Ohio. Well, what's the significance of Middle Ohio? Google where a bunch of hyperscalers are going in. Columbus, Ohio region, Google, Amazon, etc. They don't have the grid. So what do? You're like, hey, we're going to put it in UAE and Saudi. Hey, look at this. This is a great partnership. And it might be a great partnership. I don't know. But it's being, I think, done out of necessity to basically sort of make up for stuff. So there's, that's why I think what we're watching in the markets is just this growing realization of like, and you can see it in the data, right? If you look at the Citi Economic Surprise Index, it is on the lows of the past 12 months. 10-year yields aren't coming down. Like they're whatever. People say, well, they're down 60 basis points off the highs. They were at 4.95 for a second, right? They're really down 40 basis points. And oh, by the way, they were supposed to go down when Bessem, when markets fell earlier this year, and they did for like 5 days and then bounced. So they're in a pinch, and I think there's this growing recognition, like the fiscal situation's cooked. And when the fiscal situation's cooked, you get out of long-term government bonds, you get into gold, Bitcoin, stocks, houses, hard assets.
Yeah, the move into hard assets. And I've had other guests say something similar too. And I suppose like gold's probably already sniffed this out, or is it just beginning to sniff it out? Sounds like maybe there's still a lot more room to run because we might even be early innings in this too.
I think it's still early innings. I mean, some of the technicals you say, oh, maybe they're a bit stretched, whatever. Some of the shorter term traders will tell you, and they might even be right. But you can't, the sort of a corollary to the meta trade that is ongoing and accelerating, which is you got to get out of government liabilities into private harder asset liabilities, is you can't use these liabilities to settle trade. And so when we see things like the European Central Bank last week come out with a report, it was reported all over. If you include gold in FX reserves, the dollar's share of global FX reserves has gone from 60% in 2015 to 46% today. Gold's up to 20%, and other currencies, the yuan, has been a big share gain up to, I think, 16%. And that's a function of central banks buying gold and the function and central banks or gold's price. So the central banks are looking at this, particularly in Eurasia, across Eurasia, are looking at this and going, the Americans literally can't make their math work at all unless they run real negative interest rates of probably -5, -10, -15% for an extended period of time. Well, I can't settle trade in that. That's, I might as well settle trade in confetti paper. So they're buying gold. They're net settling in gold. And so this, I think it's very difficult to get off this train once you're on it.
You pointed out that you had.
All right. Let's talk about the grid. Okay. So when they're talking about the grid, right? There's this thought process that AI is our savior. AI is going to be our force multiplier, right? It's going to boost GDP. We don't have people to grow our GDP. Like, in fact, every country's numbers besides sub-Saharan Africa, we're decreasing. We're not creating more people. We're not having more babies. We're having less babies in these in the superpower world, right? None of these countries in these big what do I want to call it? First world countries, none of them have population growth, right? We all have more old people than we do young people. So AI is going to produce us out of that problem, right? It's going to increase our GDP, right? Without adding people, the computers will outwork whatever workforce that we could have produced. In order to have AI and these computers do the work, you have to have a power grid that can support AI. And we don't have that power grid. Why don't we have that power grid? Why don't we have any of the updated technology? Why don't we have a high-speed train that goes from DC to San Francisco? The reason why we don't have any of this stuff is because we've chose to spend our money fighting these proxy wars or other wars overseas. Those are the opportunity costs. You either spend your $30 trillion in the Middle East and Afghanistan, or you spend your $30 trillion at home updating your power grids. Why don't we have enough EV chargers? Why don't we have Why isn't anything up to date? If you go overseas, why does they can do everything on their phone without touching a dirty coin or a dirty dollar? How come we can't do that? Why isn't technology used in the United States like it's used overseas? It's for those reasons. We don't have we haven't spent money on the infrastructure. Our roads are crumbling. I was stationed in Germany in the early 2000s. You can go down those highways at super fast speeds. You never worry about hitting the pothole. Over here, y'all been on these roads. Y'all know what's up. So that's what he meant by the grid. Okay. Any other questions?
Yes, I have a question. I was trying to type it in the chat. So, why do you feel that America used the money for war instead of innovation?
Why do I feel like they did?
Yeah.
I mean, I think that's not the question. Why did they do it? I mean, why I think they did it is Mox Nix. They did it. You know, I can't go back and tell you, for whatever reason, they might have thought that their interest in the Middle East was uh was good to spend the money on. Or maybe they just didn't think forward, right? Like it's the same with us. If I want that new pair of Jordans, I'm not thinking forward, like, man, maybe I can use that $200 to spend on a trading account or whatever the case may be. Whatever we want to spend our money on in the now, we kind of ignore maybe something that we can use that money for in the future. And another thing is, I don't think anybody at that time believed that war in the Middle East would last 20 years. You see what I'm saying? It's not that they spent money in the Middle East, it's they spent it for 20 god dog years. Like, the number in trillions is crazy. It's amazing. And that money could have been used in a different manner to actually make more money or create more opportunity. So it's it's a hard, I don't, if you ask me, I don't really know. My answer will be I don't know why they did it, other than maybe the powers that be thought that either they could handle that situation in the Middle East faster, or they grossly misunderestimated they grossly underestimated how much money it was going to cost. And he also mentioned this guy, rare earths. Do y'all remember President Trump trying to do a rare earth deal with Ukraine? Now it all makes sense.
Yes, and Greenland as well.
Yeah,
Yeah,
this all
yep,
makes sense. So
perfect sense.
it's kind of we're getting the spotlight shown in the shadows now, so we can kind of understand why we hear this stuff or why these people talk about this stuff. Uh, you know, in under the covers of darkness.
And that's also why China's trying to move into Africa.
Of course, of course.
A bunch of Trump officials like basically begging for rate cuts. You've had, President Trump post on social media criticizing Powell, like demanding rate cuts as well. And they're cornered, as you point out. Do you have any sort of outlook for the remainder of the year as it relates to rate cuts? Do you see cuts happening in the remainder of the year? What's more of your viewpoint there as it relates to the Fed?
I don't know. I think you probably do, but I don't have a strong view on it. I just look at it as, you had Trump begging twice last week, calling Powell stupid, called him stupid again today.
Yeah.
Lutnick has begged twice. Pulte has begged 2 or 3 times. Bessent is at least a little bit more sophisticated about it, right? He has upgraded his stablecoin estimate to buy T-bills from 2 trillion 2 weeks ago to 3.7 trillion last week. So, by 2030, 3.7 trillion in stablecoins at a 0% yield, because the Genius bill, by the way, just banned stablecoin issuers from paying interest. So they're 0%. So they're teeing this thing up to take rates to stablecoins to zero. And then the stablecoins have to buy the T-bills. 3.7 trillion at 0% T-bills. Like a 0% T-bill is the kissing cousin of dollars, right? A dollar is at its core a 0% yielding bond of zero duration. It's a 0% yielding T-bill of zero duration. That's all a dollar is. It says Federal Reserve note on it. So if you're going to finance 3.7 trillion in deficits over the next 5 years in 0% yielding T-bills, that's the polite way of saying we're just going to print 3.7 trillion. We're going to print the kissing cousin of 3.7 trillion dollars to finance deficits, which is kind of where they are. So I don't have a strong view on rate cuts. I think they'll cut rates. The data is certainly softening to sort of justify that. I don't think the 10-year yields will come down like a lot of people think they will when they cut. Even if the data keeps slowing, because the reality is like entitlements and interest alone are 100% of receipts. The receipts are all-time highs, and so as the data slows, receipts are going to fall, and so you quickly get into this, you know.
All right, let's talk about what he just said. Entitlements and receipts. Y'all know what receipts are?
No.
No.
Okay,
No.
receipts, is basically the stock market, right? All right, let him repeat it and I'll kind of break it down.
I think they'll cut rates. The data is certainly softening to sort of justify that. I don't think the 10-year yields will come down like a lot of people think they will when they cut. Even if the data keeps slowing, because the reality is like entitlements and interest alone are 100% of receipts. The receipts are all-time highs, and so is the data.
Okay, entitlements is Social Security, right? Social Security or whatever they have to pay out. And then you have the interest rates that you got to finance the debt with. And your receipts are basically your GDP. So it's your stock market, your producers. Whatever we produce, we're paying 100% of that in interest payments and Social Security, pretty much, entitlements. So now y'all understand now?
No.
Data slows.
Who said no? Sweet baby Jesus.
Not just that one person. I'm like, no.
So listen. Okay. There are, you know what GDP is, right?
Yes.
Yeah.
And listen, when I say sweet baby Jesus and that stuff, I'm not saying it like y'all should know this, right? At some level, we didn't get taught anything about finances or we didn't get taught enough about economy, right? I don't know why I had to learn algebra. I should have been learning more at economics. I don't know why I had to take pre-cal or trigonometry. I should have been like, this is crazy. Okay, so whenever we have companies or business in the United States that produce things, right? We produce goods and services. The farming system produces crops. They grow corn, they grow soy, they grow things that they then go and sell to either other countries or the US government or to people who buy things, right? Everything that we produce as a country is calculated and tabulated, and it's called gross domestic product, GDP. All right, everybody understand that? So our GDP might be $5 trillion. We produce $5 trillion in GDP. Well, in order to service our debt, it might cost $3.5 trillion. So we have $1.5 trillion left. Well, with that $1.5 trillion that we have left, now we have to pay entitlements, Social Security, whatever other things that they have in entitlement programs, maybe stuff for the poor or whatever they call entitlements. Does that make sense? Let me just Google. I'm going to Google entitlements, because what is an entitlement? Entitlements, in the context of government, refer to social welfare programs that provide benefits to individuals who meet specific eligibility criteria. These programs typically established by law and guarantee access to certain benefits, often based on age, income, disability. Examples include Social Security, Medicare, Medicaid, and food assistance. Okay, so what he's saying is, everything that we produce, the money that we make as a country, 100% of that money is accounted for via, we spend it on entitlements or interest to service the debt that we've created. So now y'all understand?
Yes.
So if this was your personal
Yeah.
house, that means you get paid and you would spend a fraction of your check on food and the rest of your check on paying a loan. So if you need clothes, if you need toothpaste, if you need anything else, gas, you don't have the money for it. So you're going to have to go and reborrow more money.
Receipts are going to fall. And so you quickly get into this, you know, justify that. I don't think the 10-year yields can come down like a lot of people think they will when they cut. Even if the data keeps slowing, because the reality is like entitlements and interest alone are 100% of receipts. The receipts are all-time highs. And so as the data slows, receipts are going to fall. And so you quickly.
So he says when the data slows, receipts are going to fall. And when he says that data, he's talking about the stuff that drives the stock market, right? If you start showing signs of the economy weakening, right, the receipts are going to fall. That means the production is going to drop. And right now, with production at an all-time high, we're only, I mean, we're able to pay entitlements and interest. So when the production falls, like when the economy goes into the next stage, because the economy is not going to produce, there's called an economic cycle. It's not just going to produce all-time highs at a never-ending clip. So when the production falls, the money for the receipts, it's going to fall. And then what are we going to do?
Get into this, print this crowding out dynamic. Print the money to finance it, or you're going to get dollar up, everything else down including bonds, including yields up until you do print it, or its equivalent, whatever that looks like.
Yeah. The last time you and I spoke, which again was the end of last year, we did talk about the US dollar, and I think we were even talking about the Doge back then, if I recall correctly, that you would need to weaken the dollar before you could even Doge. I feel like we're not even talking about Doge anymore these days. But the dollar, the US dollar kind of being a cornerstone, is that fair to say, of the outlook? And help me kind of understand, like help me unpack the mechanics and the implications here, what this would mean for portfolios. Like help us understand the thesis a bit more as it relates to the dollar.
Yeah, I think ultimately it is they need a weaker dollar still. I think when we were saying that late December or whenever we talked in later in last year, the dollar was DXY was still, I think, over 100. It's now down to whatever, 97, 98. It's got to go lower. But it can't go lower too fast, because if it does that, then it increases the risk of inflation on the other side. But if it goes higher, it's going to short squeeze. There's still $13 trillion of foreign dollar denominated debt out there. And offsetting that is $22, $23 trillion all in on a net basis of foreign dollar held assets. So foreigners aren't short. They're short $13 trillion in dollar debt. That's a dollar short. They're not short dollars though, because they own $22 trillion of dollar assets. So dollar gets too strong, they will sell bonds, they will sell stocks. Stocks get too weak, they'll sell bond. They'll sell bonds because receipts are tied to stocks. They got to keep the dollar moving down in sort of an orderly fashion, or else the math just doesn't work.
I don't know about y'all, but that's music to my ears, boy. They got to keep moving the dollar down in an orderly fashion. So, this pullback is a scheduled, it's a regular scheduled pullback in the program. And when you look at that chart, and we'll go look at the EU or GU chart here when we finish this video, you can see where we're at the bottom of a trough, right? The GU and EU push way down, and now it's curving around, coming back up. And this is just a pullback, a temporary pullback on this up move. If you look at that 6-month candle, we got a 6-month bullish OB. So that's confirmation. What he's saying is confirmation on what we see on the chart in the technicals. So it's beautiful.
Gold prices have been breaking all-time highs this year, but price appreciation isn't the only way to profit from owning gold. You can earn a yield on gold paid in gold without selling your gold or silver. Unlike dollar yields that can be slashed or even go negative, a yield on gold paid in gold means more ounces in your account every month, not paper. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities for you to earn 4% on gold paid in gold in their marketplace. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning a yield in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. And as you also pointed out at the top of the conversation too, like I thought this was interesting. I wrote down the note here around the weaker dollar would mean lower 10-year treasury yields, but those relationships have broken, they've diverged. Can you talk a bit more about that kind of disconnect that we've seen and the implications there, especially if you see more on the bond market side?
Yeah, if you look at the past several years, there was let's go back in time a bit to sort of 2019. There was stronger dollar, and the stronger dollar. Let's back up. There's $13 trillion in dollars in borrowing. There's $22 trillion net. I want to say almost 60 trillion gross of dollar denominated assets held by foreigners. Every time the dollar's gotten too strong, foreigners have sold treasury bonds first. And so in risk off since really late 2018, but particularly 2019, 2020, 1Q20, 3Q22, 1Q23, 3Q23, 1Q24, again earlier this year, 1Q25. Anytime the dollar has gotten too strong or anytime there has been risk off, you get a brief decline in 10-year treasury yields, and then 10-year yields start rising. In other words, bonds start being sold alongside stocks. And then liquidity is added one way or another, and sort of that stabilizes. That's been the pattern. We've been saying since summer of 2022, as we were watching the dollar go up and up and up, as Powell was raising rates, and consensus on Wall Street was he's going to be the next Volcker, even if he has to induce a recession. And we were saying basically that, this isn't going to go the way you think it is. And what we were saying at that time was there is going he's in because the debt is so high. By raising rates, all he was doing is increasing the deficit, which is stimulative, not not constractionary. And that's exactly what he did. And what he said is what we said was ultimately because they didn't let inflation run high enough for long enough, right? Everyone said, oh, rates higher for longer. The Fed screwed up not by acting too late. The Fed screwed up by acting too early on inflation. They shouldn't have raised rates. They should have let inflation run hot through 22, through 23. They could have gotten the debt to GDP down. They could have kept doing QE. We would have had our bad inflation. Biden would have gotten, they would have gotten crushed in midterms. He would have gotten crushed in the election, but we'd be in a better shape as a country. What we said in summer of 2022 was by Powell trying to be Volcker, he's setting himself up for a moment where his choice is how he wants to lose the long end of the bond market. He can do it by cutting or he can do it by hiking. And we saw them kind of try to split the baby, if you will, ride two horses with one ass in 3Q22, where Yellen kind of stepped in from Treasury and started running down the TGA to offset Powell's QT. We saw Powell come in and unwind his own QT with BTFP, but only for the banks in 1Q23. We saw 3Q23 with dollar weakening and more Treasury as a result of more Treasury dysfunction. And in 3Q24, there were a whole lot of people that were saying, well, why is Powell cutting rates 50 basis points in September? And we were saying at the time, it's the Treasury market. You were seeing rising Treasury volatility rates, implied volatility Treasury move index, because foreigners are not buying enough Treasuries. Foreign central banks have not bought a single Treasury on net in 11 years. It's all private sector. A lot of it is hedge funds and tax shelters. I mean, the Cayman Islands, I think, population 65,000, I think is now the United States' fourth biggest foreign creditor, right? That's hedge funds. UK is number 3, I think, maybe even number 2. They might have surpassed China. Again, UK runs twin deficits. That ain't based on trade or trying to manage the value of the pound. Those are hedge funds. Those are funds. They sell when Treasury ball rises. So Powell cut rates, and a lot of people said, wow, the 10-year sold off on him cutting rates. That's not what I expected. It was exactly what I expected. Like, he chose. And now here we are again, a little bit of the same thing. Is he going to cut in the second half? I don't think the 10-year at the long end is going to come down much at all. He's stuck.
He's going to go
if he
up.
lets the economy continue to weaken, receipts are going to go below interest on the debt and entitlements. And so we're not going
to. Oh, this is funny. Okay. Do y'all understand what he's saying? Who's getting confused? Come on, y'all.
I am a little bit, yeah.
I am confused
I
too.
gotta he lost me.
Okay. Do y'all remember the last rate cut in September? Before Trump took office, we cut the rates by 50%. Y'all remember that?
Yes.
Or 50 basis points. And the 10-year rose. Generally speaking, when you cut interest rates, the value of your currency goes down, right? And the value of your bonds will go down with your currency. Well, in September, when he cut interest rates, the 10-year interest rate rose instead of going down. And I remember I said, man, why is it going up? It should be going down. And what he's saying is he knew it needed to go up because you have to make a choice. Like Jerome Powell has to make a choice. He's either going to crush the dollar or he's going to crush the bond market. The bond market is, again, that's where the government borrows money, right? So if the bond market goes up, like if he cuts interest rates for you, the bond market interest rate is going to go up. So it's going to cost the government more money in the future, right? That makes sense? If he allows interest rates to stay where they are, uh, and it brings the economy to a grinding halt, that cuts receipts. Receipts are what we're using to pay the interest and entitlements. Y'all get it? Yay, nay?
Yeah, I'm following.
Okay, so it's a catch-22. You you either default, well, you can't really default, they're just going to print money. But what's going to have to happen, I think what he's alluding to is, hyperinflation is going to happen. We're kicking the can down the road. But he's saying the Fed should have allowed inflation to go higher, back when we thought it was high. Remember when we thought it was high coming out of the pandemic? Did y'all think inflation was high?
I didn't think it was that high compared to how.
Yeah,
You didn't. I mean, you're not in America. What are you?
I thought inflation was high. Yes, I did. Absolutely.
Did this
You
girl
did
say
over here. Yeah,
she
in the
Deanna
States.
said she didn't think inflation? Yeah, you're not in America.
In terms,
Inflation,
sorry, in terms of
inflation
the
was
data,
it was
when I'm
incredibly
looking,
high here.
looking
In
at the
America.
data, it didn't seem that high to be cutting rates the way he did.
No. You're gravely mistaken, Leandra.
How am I grading mistake?
Coming out of the pandemic, rent was exceptionally high. Food prices, they're still high. I mean, we had shrinkflation. Like even the cost of a bag of potato chips went up, and then the what you got in that bag was way down. It was more air than chips. So inflation was incredibly high back then. They said inflation was 9%, and it was the real inflation was probably something like 19%. Inflation got to 9% in the United States. That's the highest that it's been in my adult life. So what he's saying is the Fed should have allowed it to go higher and for a longer period of time. Yeah, it's going to be some pain. Like we can't avoid that. There's no way that we're going to avoid pain, and it's total. It's for everybody. Everybody is going to have to endure some pain, y'all, and it's coming. That's what he's telling you is that this pain is coming. So who knows how high the inflation will be? But even me, here in Colombia, I make U.S. dollars. When the value of the dollar drops, the cost of living overseas gets higher, right? Now, it's still going to be a lot cheaper for me, than it would be if I was in the United States. But it's still pain for all involved. And I think everybody should start preparing for that pain and start understanding. But more importantly, it's easier for us to endure the pain if we're invested properly, right? It's the same way that these guys grew their net worths to billions of dollars, over a 10-year period because they're invested properly. They're invested in the stock market. They're invested in real assets, be it Bitcoin, be it homes, gold, right? You have to be you have to put your money in the right places when you understand that inflation is going to go higher, right? Like we all should understand right now that when inflation goes high, you don't want to have your freaking money in a bank. The interest rates you're getting paid in the bank is trash compared to how high the interest is outside, right? The food is going to cost you more in interest than you're making in the bank. Yeah, yes, Alfred.
I have a question because I'm not sure if I understand the relation or correlation between when he said, or yeah, when he said that, or you said that the dollar going down makes the bond market, the bond market should also go down, right?
Yes, yes.
And then you said that um the government, it's gonna be more expensive for the government or something. And I'm not sure if I get that.
Okay. In the past,
Yeah.
when the dollar goes down, the 10-year bonds go down too, right?
Mhm.
So in essence, if the Fed cuts the interest rates, then that 10-year rate goes down too, right? What that means is the government can issue more debt at a cheaper rate. And the foreign entities buy that debt, and they don't have to pay that. The government doesn't have to pay in full for 10 years or whatever, but they're paying a lower rate 10 years from now. Does
Mhm.
that make sense?
Yes.
Well, now when the Fed cut the rates by 50%, the bond rate went up, the 10-year went up. So now when they sell those treasury bonds, the 10-year treasury bonds, they're going to have to pay a higher rate 10 years from now.
So who controls the rates for the bonds?
The market controls the rates. It's based on what's really going on. It's just like you, right? Um, Whenever you go get a loan, the bank looks at your credit worthiness, right? It looks at how much money you have coming in versus how much money you're asking to borrow. So if you have very little money coming in, and you want to borrow and max out uh, your earning potential, you're going to pay higher interest because you're a higher risk. Does that make sense?
Mhm. Yeah.
It's the same with the government. The the treasury bonds, that rate is going to adjust based on the receipts that we have coming in and how much money that we're spending. And we're tapped out. So that's why that rate goes higher. If you increase, if Powell increases the interest rate, that 10 year is probably going to go down, which is jacked up. I mean, you know,
Okay, so
uh,
but they're still able to print money when they need it.
well, but printing money is a form of liquidity, right? It's
Mhm.
if you print money, it's going directly to your stock market, right? That stock market is going to run up. The problem with the stock market running up is you have a small percentage of your people who invest in the stock market. None of your people, none of my people invest in the stock market. So, other than my brother and maybe a cousin or two, but most regular Americans are not invested in the stock market. So only the people who are invested in the market are going to get that huge return. Everybody else is going to get crushed by the rising cost. Does that make sense? If you raise the interest rate, everybody is going to complain, right? Because it's more expensive to borrow money. Jobs are going to go away. Companies are going to lay people off. The economy is going to come to a grinding halt. But the 10-year rate is going to drop. So, you know, it's going to be a game that they have to play on a consistent basis. But at the end of the day, what this guy is saying is the government has to get the dollar to systematically move down to kind of to get unscrewed from this situation. But in the process of bringing the dollar down, they have to do it in an orderly fashion, and um, they're going to have to make a few adjustments. But let me let him. I don't want to get ahead of what he's talking about.
Cut, the interest won't come down. It's only going to go up actually because it's still below market, if you will, right? In other words, the weighted average coupon on the debt, I think it's still in the threes. It's on its way to 4 on 37 trillion in debt. So that's going to keep going up. Entitlements aren't going to get cut. Entitlements are growing 2 to 3 times faster than receipts because boomers. And look around you. We're not exactly getting healthier as a society. And now we're throwing war on top of that. That's not, that's, more defense spending. That's neither here nor there. But so like if he doesn't cut rates, then we're going to get into a potential moment where, you get dollar up, bonds down, stocks down until they have to react. And if he does cut, you're going to get stimulative. I think, maybe we get a momentary decline in the 10-year yield, but not by much, not nearly as much as all the bulls think. And then I think it's going to take off like a scalded cat, like it did last September. And then again, I think he's really going to be exposed. Pete Powell's really going to be exposed to exactly how cornered he is, which is, to the first point, that's what the divergence between dollar yen and, the yen and the 10-year JGB yield and the dollar and the 10-year treasury yield. That's what it's telling us. That's what the divergence between gold and inverted U.S. real rate is telling their stock. So that's, I don't have a strong feeling on rates. People asked me at the time, what did I think Powell should think? What do I think he should do? I think he should go get in a time machine, go back to
I mean,
December.
let him know that like it's not like the money isn't
the hero for
Like
fixing
they'll
COVID,
get it
because
back.
it's all downhill from there.
We need
So
it before.
you don't see any potential solutions, and like he's just stuck. It's just that.
Well, there's solutions. There's just, the solution is there's a rock hanging over two people's heads, and whose head does Powell want to drop it on? And when I say rock, I mean like the friggin' boulder in Indiana Jones, right? Like, do you want to drop that on the dollar, or do you want to drop that on the bond market? Basically that's his choice.
And
He's got to crush the dollar, or he's got to crush the bond market.
which one do you think?
And by the way, if he crushes the bond market, literally he's going to crush the dollar like 2 months later, because yields will spike. And as soon as the market sniffs out that, oh my God, interest is way, they can never do this because the receipts are interest rate sensitive. So the receipts will decline non-linearly. And their interest, at 120% debt to GDP, their deficits are going to rise non-linearly with it. The market will sell the dollar then either way.
Mm-hmm.
He's stuck.
Okay.
He screwed up in 22. He needed to let inflation run hot.
Okay. I'm also just looking. The last time you and I spoke, I want to say that our U.S. debt was probably just north of 36 trillion. It's now obviously it's north of 37 trillion. And you also point out like entitlements are still increasing. Like the math just does not look good. And you also kind of brought up this point. We were doing like all of this deficit spending too. Like we weren't in a wartime either. So it kind of makes me wonder too, the fiscal picture, and there is heightened geopolitical risk out there as well. How do you think about, how do you think about that risk and the fiscal picture? Like, I don't know, is there a way the math could work out? Or I know you don't like the term end game or anything like that, but how do you think this plays out?
Yeah, there's a way that math. Yeah, I think there's ways the math can work, right? Look, if we have negative 15% interest rates, real interest rates, right? We run inflation at 15, and we run we have the Fed pin rates at 0. Math works fine. Math works
but that'd
fine
be very painful.
for a bondholder.
Yeah.
For bondholders, not for gold holders or Bitcoin holders or equity holders, or if we constrain, if we close the borders as well, it'd be great for wages. It'd be terrible for business. It's bad for profits. It's bad for profit margins. It's great for profit dollars, right? Profit dollars will go through the roof. Profit margins will tank. Investment will surge, because if we close the borders, there's everyone and their mothers gonna be trying to invest in productive assets and capital to try to replace labor, whose wages will be going through the roof. Labor will love it because they'll be getting 15-20% wage increases while the Fed's got their mortgage pinned at 2. It's bondholders and Wall Street lose. Washington wins because their real value, their deficit collapses. Inflation surges. Politicians hate it because inflation's going to go nuts. They're all going to get voted out of office in 6 months. But you know what? Be better. They made these choices. The math can work that way. The math could also work is if boomer mortality spikes in the next 24 months. Math works great, right? You've got 70%, 70% of receipts, which are at all-time highs and tied to the stock market, go to entitlement boomers or boomer entitlements. If, you know, you can do the math. If there was a sudden spike in mortality, the math starts to work again. Look, I don't think it's going to happen, but there are ways the math can work. That's why I say, like, there's no pleasant ways the math can work. Productivity miracle. If it arrives fast enough, because we're already sort of past the threshold, let's have a productivity miracle. AI. Well, AI is going to, let's say it shows up faster and does more than we think. Well, arrives faster and does more than we think means a whole bunch of white collar people are going to lose their jobs. And a whole bunch of white collar people have mortgages and car loans. And when they lose their jobs, what do? This is what I meant earlier about, China was the first AI. I know what they do. They stop paying. I saw it here when, the Ford guys and the GM guys went from making 30 an hour full bennies to $12 an hour at Walmart, no bennies. They stopped making payments on the bass boat and on the truck, and then finally on the house, and then the banks start going kaboom. And so, like, that's not that's why I say we could get a moment of deflation, but then you go, okay, is the Fed going to sit there and let their banks blow up because AI has crushed the consumer loan market and the mortgage market? No, not in my opinion. They're going to print every dollar they need, and we're right back. So, there are solutions. There's always solutions. There's no end game. There's just, once you do enough dumb stuff on borrowed money, and it's completely uneconomic, unproductive, right? I mean, in 2001, when we had $6 trillion in debt, we have put on $31 trillion in debt in 25 years. What have we gotten for that 25 trillion? What have we gotten? Do we have the best highways in the world?
No, in our airports.
Do we have an amazing high-speed rail system? How are our airports, right? Go overseas and tell me how our airport. What have we gotten? Nothing. And so, like in the end, economics hold, right? And if you spend as a company, if you spend 25 billion, you have a $25 billion company, and you spend 25 billion on debt, and you take it and blow it all on red in a single trip to Vegas, now it's gone. Like, the equity value of your company suffers. Well, we blew $35 trillion going to Vegas, going to the Middle East, and betting it all on red, and we lost. But countries, like, they don't have their equity get wiped out to zero. They just
Print money.
print the money and refill and go bet on red again. So that's the practical, example of what I'm talking about.
Yeah.
It just changed the rules. And so, like there's solutions. It's not that there's not solutions. It's just that nobody wants the solution. The solution is Powell's got a huge boulder holding it over the heads of either the people who hold dollars or people who hold bonds, and over the dollar or over bonds, right? And he's got to let it drop on one of them. And if he drops it on the people holding bonds, he's going to drop it on the people ahead holding stocks. And he's going to hold it paradoxically, that will also crush his own receipts, because if stocks fall, receipts fall. And he creates a debt crisis either way. So, like, he might as well get his money worth. He screwed up by not letting inflation run higher for longer. And now he's going to have to.
It also makes me want to bring up a point.
What's up, Kate?
So, I mean, I hear it's very doom and gloom, and, we've overspent and we're living like on credit cards, blah, 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 right? So in a person's life, they would just file bankruptcy. So what's the equivalent of America filing bankruptcy? What does that look like?
We're printing money. To me, that's the equivalent of filing bankrupt. You are bankrupt. Everybody knows you're bankrupt, because that's why nobody is buying those government bonds. That's why no country is buying government bonds. They'll buy your stocks. They'll buy Apple stock or Tesla stock. They're not buying those government bonds. So we have to buy our own government bonds.
So is that why the guy is saying, like, there's no bottom, or he said something like there's no end to this? Like, it's just this endless cycle of printing money to bail us out, and then
that's all we can do. But what he's saying is that inflation is just going to get higher and higher. That's the way it works. And at some point, they're going to have to stop trying to fight it and let the inflation hit to the point where it erodes the the deficit, right? So if inflation shoots way up, uh, your real debt, your debt decreases, right? Because real assets go up, but the money number decreases because inflation erodes that money number away. But inflation also erodes your personal money away. Like when you're paying $30 for that Big Mac combo, you really feeling the inflation.
Right.
So it's the same thing. Y'all used to hear my brother saying, do you think the value of your grandma's house really increased by all that? Like if your grandma had a house in South Central LA in the 60s, she might have bought that house for $60,000 or $70,000. Now it's worth $500,000. It don't even have Wi-Fi connections. It don't even have central air. Why is that house worth $500,000 or $1 million? It's not because the value of that house has increased. It's because the value of that dollar has decreased.
Okay, wait, quick question. I know you're saying like the house itself didn't increase, but is it not like something linked to the fact that the land that it sits on, the location, like the
Can
land
you,
value increased
can
maybe?
you, can you, let me ask you, I'll ask you in a different way. I don't know how old you are, but when you were a kid and you went to McDonald's to get that Big Mac combo, how much money did your mom and dad pay?
First of all, I can remember my teenage years. I don't know how much my parents were paying for Happy Meals when I was a kid, but we could get like for $5, you can get a whole meal at Wendy's.
Can you get that same whole meal for $5 now?
No, because they've reduced the nugget count, they've reduced the size of everything,
But
and
so how
it's
much
like
does that meal
$7.
cost? So it's $7. Did the value does it taste $2 better?
Okay.
I know that
No,
sounds funny, but that's really what I'm asking you. Like,
I got you.
you know, I'm telling you, nothing. Those houses and that land did not increase that much in value.
Right.
No, absolutely not.
Let's see,
The
like,
the the dollar has decreased in value. It's just okay. Let's talk Bitcoin. A few short years ago, Bitcoin was $3,400 a coin. $3,400 a coin. Now it's over $110,000 for every coin. Did the value of Bitcoin increase or did our currency decrease? We laugh at these other countries. I'm here in Colombia, and um, you know, I got $100,000, 100,000 pesos. And that's probably like $40 or $50. 100,000 pesos. Pretty soon in America, they're going to be printing $2,000 bills, and it's going to be like $2. And that's due to inflation. Our currency is becoming worthless. The same way that all these other countries have worthless currencies. And we always laugh. Like have anybody ever been to Cuba? If you go to Cuba and you give $100, they give you like a brick.
I've been to Cuba.
Yeah, so you get a brick of Cuban currencies for a $20 bill. So it's the same thing that's happening in your face. The value of your dollar is extremely different. And I'm old enough to remember where I can go with a dollar in the 7-Eleven and get the little candy, the little Jolly Ranchers for 3 cents. And the value of that candy did not raise all those cents. The value of the dollar dropped all that money. You could get a Snicker bar for 45 cents. How much is a Snicker bar now?
I literally paid $3 from a sticker before.
Listen, and that is 5 times the amount of what it used to be. And the value has not increased. The dollar has decreased, and that's what he's saying here. He's telling you. He just said that the way out of this is they have to continue to devalue the dollar. Right? They're going to devalue the dollar. So what does that mean for everybody who's not a trader or who's not an investor? What does that mean for your mom, your aunt, your cousin?
That means you're going to get less for your money.
Yes,
That
it's
means,
coming.
yeah.
It's coming. It's not avoidable. It's coming.
It's already here. Like, it's just
Well,
going to get.
yeah, but it's going to get worse. The dollar, he's telling you the dollar needs to go at least to 90. That's 700 points from where it is right now. You haven't been trading. You've never seen the dollar that low while you were trading. So it's coming.
You brought up earlier, and you are one of a handful of guests who's talked about this, and that's fiscal dominance as well. I would love to hear more on the fiscal dominance side of things. Are we already in fiscal dominance? And I believe in the past, you've referred to that as kind of this shadow third mandate for the Fed of like realizing the fiscal dominance.
We are in it, and it is a question at any given moment in time. There are degrees of fiscal dominance, right? So for me, once true interest expense is over, call it 95% of receipts, then yes, 100% we're in fiscal dominance. The way you get out of it is you've got to let real interest rates be significantly negative. You got to let stocks rip, because stocks drive marginal receipts in this country via consumption. So if you let real interest rates be, I don't know, -5%, right? So inflation running 5 points above where rates are, and stocks are rising 20, 30% per year for several years, you're going to quickly have a receipt boom. And when you have a receipt boom, you will actually grow your receipts faster than those other line items. Particularly if you can lie to the people about exactly what inflation is, so they don't, their cost of living adjustments and entitlements don't ratchet up as quickly. And like if you have 2 to 3 years and -5% real rates and 20 to 30% increase in S&P, like you get what we got in 2020 and 2021, which is the deficit went from 3.1 trillion to 1.4 trillion in 2 years. True interest expense as a percent of receipts went from 105 to 85 in 2 years. Like, there's always a solution, but it's what Jean-Claude Juncker said it like 10 years ago. And we all know what we need to do. We don't know how to get reelected after we've done it. That's where we are. Like, they know exactly how to do it. But again, the dollar's got to get killed. Inflation's got to surge. Bonds got to get killed either nominally or on a real basis. They can't get killed nominally, so they got to get killed on a real basis. And that's going to honk a bunch of people off, and then they're not going to get reelected. So they're the squawking from the Trump administration, I think, is them realizing like, oh God, Doge didn't work.
Yeah. I feel like you're probably pretty skeptical of Doge going into it.
Oh yeah.
Yeah.
I mean, I said, look, if they don't devalue the dollar first, it's not going to work. And people said, oh well, don't worry, he's going to let risk assets fall. And when they let risk assets fall, when they let stocks fall, there'll be a rush into 10-year yields. They get 10 years down to term out the debt. That's what they're going to do. We're going to cut. We're going to let stocks fall, and that will drive 10-year yields down well into the threes, into the low threes, maybe even lower, and then he's going to term out the debt. And I said, unless they devalue the heck out of the dollar first, like they're smoking crack. And I was right. They were wrong. Stocks went down. Bonds went down at first. Like, oh, see, it's working. It's working. I was like, wait for it. Wait for it. Boom.
There
6
you go.
days in, 10-year yields start taking off. And all of a sudden, Like, now what, wise guy? What are you going to do? Like, your stocks are down, which means your receipts are going to be down. Your yields are up. It showed a gross misunderstanding on the market's part, on consensus's part, and on policymakers' part of how the whole thing's working.
You were right
And then
because
Doge, I was like it's yeah, Doge, like cutting Doge, like I'm like, dude, we're gonna cut a bunch. I'm like, you are spending 120% of receipts on entitlements, interest, and defense. You're not gonna cut defense. You're not gonna cut entitlements. We're gonna strengthen the dollar, not by cutting rates enough. Look, that was the only thing you can cut is interest. And Powell's not cutting rates for you. So what are you gonna cut? And sure enough, well, we thought it was 2 trillion. It's actually a trillion. It's actually 14 billion or whatever it was, some like ridiculous 130 billion. It was like a stupidly low percentage of what they thought they were going to cut.
you were right because even I remember that. And it was like a couple months after the interview, like people were still in the comment section commenting on your interview because I think people went back and watched it as well. All right. Maybe just to reemphasize from an investor perspective, like how you want to be allocated. You mentioned hard assets, gold, Bitcoin being another. I do want to hear your thoughts on Bitcoin, but and obviously avoiding these kind of government-backed treasuries, especially on the long end of the curve. So maybe just walk us through.
Yes, and the long end. Like I've got a big position. Yeah,
Yeah, you have
yeah, I got a big
T-bills, I think.
position in T-bills. Like I think
Yeah.
T-bills are fine. Yeah.
Mhm.
How I want to be positioned is low over my skis because like I'm overweight gold, I'm overweight T-bills, I'm overweight Bitcoin. I think the U.S. government sees stable coins, they very clearly see it as a way to financially repress and create an ability to finance deficits at very low rates. Besson can't get 3.7 trillion or 2 trillion even in stablecoin T-bill buying over the next 5 years without Bitcoin probably being a multiple of where it is today. It's very hard to see a world where the stablecoin market cap is bigger than the Bitcoin market cap. Let alone, and as a practical matter, going back the last 3, 4 years, whatever the market cap of total stable coins, Bitcoin has never been less than 2.5 times that. And it's been as high as 10 to 12 times that, right? So if Besson's talking about 3.7 trillion in stable coins by 2030, in my opinion, he's talking about 8 trillion, 9 trillion Bitcoin, up from 2 trillion today, 2.1 trillion today, or up to 30 trillion Bitcoin, up from 2 trillion today. Like the U.S. government now needs much higher Bitcoin to achieve their stable coin goals. So that's, I think, really interesting. And other than that, like I'm sort of very low over my skis because there are real constraints that are not priced in right now. The dollar, 10-year yield and yen, 10-year JGB divergences, that's a problem. And I don't know what's going to trigger it. The United States can't go to war without Chinese rare earths. I know we just had this glorious victory, and look, regardless of what one thinks, I think it makes sense to make sure the Iranians can't get a nuclear missile. A nuclear weapon. I understand that. Great. I think it was a great limited raid. It was successful. No Americans were hurt. That is awesome. And the reality still exists. We can't fight a war of any duration without Chinese rare earths. So, in addition to being a very efficient raid, it was also very efficient marketing. Even if we wanted to have a lengthy war, we can't without Chinese rare earths. There are real constraints. How do those real constraints manifest themselves? I don't know. I don't know if that freaks markets out or if markets go, oh gosh, there can't be a war. The Americans can't go to war. Oh, I don't need to own bonds. I need to own stocks, right? I need the hard asset play, right? I don't know. I see things on the grid and on the labor side, like they're inflationary, full stop. I see things on the AS side, it's very deflationary for a moment. And then it's, again, I've seen how that worked here in the Rust Belt. People stop paying their boat loans and their car loans and then their mortgages if they get displaced. And that's what's coming for white collar. And I don't know if that's coming. It's probably not coming in the second half of this year, but it probably starts second half of next year and the markets look 6, 9 months ahead. I don't know how to weigh all those things, but that's where I kind of shake out for the moment until I get more clarity. especially seeing where the fiscal is, there's a reason they're all begging for their rate cuts. They know they're cornered. Powell. So where do I think, let me lay out two scenarios. I think it's one of two most likely scenarios are sort of my base case. The first is Powell continues to not cut rates, and we have an economic slowdown, and the dollar starts to rise, and then all of a sudden 10-year yields start rising, and 10-year treasury yields hit 4.6, 4.7, and all of a sudden stock market starts to fall, and it starts to fall sharply, and then 10-year yields go back to 4.4, and then they, for maybe 5 or 6 days, and then they take off back toward 5. And now Powell's facing a rapidly slowing economy and a falling stock market and a rising long end, and he has to cut into that. That's scenario one. And then we get the softer dollar, and then I think Bitcoin rips, gold rips, but stocks rip. Scenario two, I think, is he cuts, and the dollar goes from 98 today towards, I don't know, 90 by year end. And that is like party on Wayne, party on Garth. I think for everything except the long end of the curve. I think the long end probably doesn't go up as much in that case. It probably goes from 4.3, where we are today, 4.35 to, it probably panics at first to 4.45, 4.6, but then comes back down to the surprise of a lot of people to 4.4, 4.5, which is fine. Bitcoin rips, gold rips, stocks rip, and like inflation starts picking back up by the end of the year, and then we can deal with that in the first half of 26 is our concern. But those are my two, like if I laid those two scenarios out, I would say, I'd probably say there's a 60% chance of the second scenario. I'd say there's probably a 30% chance, 35% chance of the first scenario. And, sort of fill in the blank. There's some other things that are, they used to be 1% tail risks, and now they're, 10% tail risks.
What for you is the biggest risk that's keeping you up at night? And maybe to end on a positive note too, what's something that's making you optimistic? So two-part question.
What is something that keeps me up at night?
It doesn't have to literally keep you up at night, but something that's on your mind. Yeah, the biggest risk.
Look, where I'm going to be like totally wrong and have to completely, like if there's one thing where he's like, if it changed, if you had like significant regime change in China and or Russia, like where all of a sudden we get a new Yeltsin who's just willing to, sell off the Russian, sell off Russia to Western oligarchs piecemeal, all in dollars, that would force me to change things. I think if we had some sort of new regime where in China, the leader suddenly is like, hey, all we want to do is own treasury bonds, yielding, negative 5% real rates. And, we're gonna not, we're basically gonna go back to sort of 2001 China. And that would force me to have to completely do an about face. That would change things. That would certainly buy time for the fiscal situation. I think there's almost zero chance of both of those things happening. For a number of reasons, but those kind of things are the things where I kind of go, okay, where as I'm constantly thinking about where are my blind spots in this. Those are two of the biggest. And sorry, the second question was what? Something I'm optimistic about.
On, yeah.
Look, I'm optimistic that the world, by the time my kids are adults and having kids, are going to be in a much better spot. Like, look, the boomers have screwed this all up. And it's not just their fault. Their parents, them, like no one wanted to be an adult. There was no political courage. In 1989, we should have had a new monetary conference where we rebalancing, basically a new Bretton Woods. And instead, the leadership of the time said, we have a unipolar moment. We're going to do this. And the success of that unipolar system sowed the seeds for its own demise. And that's what we're watching. And so I think ultimately, to be optimistic about is over the next 5 years, I think you're going to get a significant decline in U.S. debt to GDP on a real basis, one way or another. It just depends on how they get there, how they do that restructuring. And then on the other side of this, you've got some very promising new technologies, things for healthcare, I think, some of the things that Bitcoin brings to the world in terms of monetary system reform, some of the things that are being done with gold, monetary system reform as a neutral reserve asset, those things I think will ultimately, it's gonna be a much better world for, in 5 to 7 years for my kids as they become adults. I mean, they're technically already adults, but they're, very young adults. So I'm very optimistic about that. Like I said, there's always solutions to these things, right? They always work out in the end. There's just, what's normal for the spider is chaos for the fly. And I think what's coming is, if you're a long-term bondholder, government bondholder, I think the next 5 to 7 years are going to look a lot like a spider to you, and you're the fly. And that's, on a real basis. You get paid every dollar you're owed. They can't make their math work unless they really repress you. They're telling you that. They're begging for it. Like when they tell you that, you should probably believe them.
Yeah. A quick question on the long-term bondholders? Are those are the suckers at the table, I take it. And are they hedge funds or is it retail investors?
It's retail investors, as usual. You can look at every quarter, the Treasury Borrowing Advisory Committee puts out a report, excellent report, it must read. And it shows what groups have been, amongst all the other information, what groups have been the buyers of the latest Treasury auctions by tenor. So they have one that's of bills, they have one that's 2, 3, 5, the belly of the curve, and then they've got 7, 10, 20, and 30 years. Like I look at 2, 3, 5, and then 7, 10, 20, 30. I go back to 2011, 2012, what they call investment funds, which is, in my view, a proxy for retail. That was 11, 12, 15%, those auctions. It's 70 to 75% now. Foreigners back then were 40, 50. They're down to like, 10, 12. So like, yeah, they've loaded retirement funds and mom and pop retail up with mid to long-term treasury bonds. This is the first cycle where those groups aren't the suckers at the card table. Like it'll be the first time in my 30-year career because they're always the suckers at the card tables and everything else. .com, they were the sucker at the card table. Housing, they were the sucker at the card table. Inflation, they were the sucker at the card table. So like, and yet, like that's fair, right? We would try to find the most politically balanced solution. The reality is, again, that generation is getting 70% of tax receipts that are at all-time highs in entitlements. How does that make any sense for my kids? I don't know if you have kids, for your kids, for any of the younger generation. It's not like our educational system's killing it. It's not like our, healthcare for poor children is killing it. No, they're talking about making cuts to that stuff. Why? So that the wealthiest generation in the history of mankind can get 70% of receipts? How does it make any sense? So it's actually it's basically raising taxes on the boomers without raising taxes on the boomers. Get them loaded into this paper and then devalue it. Their stocks will still go up. And you know what? Like you got to pay more for what, I'm changing the deal. You got to pay more for it. It's as close to fair as you can get. Hey, you have to pay for what you're using.
Look, I have to say, I love having you on. You are such an incredible voice in the macro world, and I know this audience loves listening to you. Before I let you go, let folks know where they can find more of your work. I know you have a subscription as well to your Tree Rings newsletter. So the floor is all yours. Anything that you want to plug, it is all yours.
Thank you. I appreciate this.
Yeah, Luke is great. But hey, all that's good if the boomers are invested. And the problem for me with what he's talking about is only the affluent people are invested in the market. Most of the people I know, they don't know anything about a stock market. So they don't understand economics. They don't understand, the economic cycle. And they're not going to understand why they're getting crushed by inflation. So, I think and it's not just this guy that's saying, every podcast that I've heard either says the market is going to crash or your dollar is going to get devalued. And there's a scenario where they can both happen. But eventually, we need to go through hyperinflation in order to get to the other side of this conundrum that we're in. And the ugly truth is nobody is going to say that, right? Nobody's going to come out and say this is what has to happen, and it's because nobody wants to lose their election seat, right? So, that way we can just take the scab off, and we can kind of all understand what's coming and understand why the charts look like they do. Why has the dollar been coming down? And why has the 10-year not been moving with the dollar? So I think that's the main takeaway. So this 10-year has been as high, let me see, as 4.7, I want to say, or 4.6. Okay, it's been as high as 4.63, as low as 4.1, right? And now that the dollar's going up, it's moving back with the 10-year. Let me go to the Dixie. Okay, they're both bouncing, but you can see where the Dixie came from, 110. So since January, good Lord, the dollar has sold, 1,400 pips, and we're just going to pull back and sell again. So at least we know that we'll be selling another 1,400 pips or so after we pull back. It's a good trade, right? It's good for multiple reasons. We started this call off, talking to Kenya about, oh man, I got in the EU sale and it went up and came back. So long term, you can probably ride these trades to their destinations and then ride them. You can ride it long term down, and it will probably insulate you at least a little bit. If even if you're not a great trader, it'll insulate you at least a little bit against higher prices because I just don't see a scenario where we're going to avoid the higher prices. In fact, there's not a scenario that we're going to avoid higher pricing. The only way that prices don't go higher is if the economy crashes, like if everybody gets fired. And then the reason why you don't face higher prices is because nobody has a job. And that's called a depression. So, pain is coming. Everybody is going to have to endure it. We can all get mad or whatever, but at least you know about it, right? You know about it now that it's we're all getting sucked down that drain, the inflation drain. And we're going to get lied to the entire time. Nobody's going to come on TV and say, hey man, this is what we do. Everybody keeps saying they have the plan and it is this person's fault and it's that person's fault. We're just past, we spent too much money and we're past the point that we can make corrections to that without everybody getting led to the slaughter. If you're long on stocks, during high inflation period, the indices, real assets, Bitcoin, gold, they all go up. So I think we all kind of understand that, but you just have to kind of learn to get into the trade and start holding it longer term, or just get really good at trading short term. If you're a great trader now, then none of this really matters to you because you're gonna make your money regardless, right? Uh, it won't be worth as much, but you'll still make it. If you're not a good trader, um, I would suggest that you focus on a longer term trade, right? Like this trade right here was 1,400 points. It's a long, it was a long-term downtrend. You know, we broke the low. Now we're going to get a pullback, right? This correction, it's going to be a lot of pips. So focus on those longer term trades. That way you can kind of just add in, you can build your position. You can keep adding in. I would manage that position from a higher time frame. Uh, I'm doing mine based on the 2 day time frame. And when I get my pullbacks on that 2 day chart, maybe I can add a position, and maybe that'll happen, every week. And nobody says you have to add more than two. If that's all you're comfortable with, or more than three or whatever, right? You don't ever add more positions than you can manage or you feel comfortable with. But once you get the hang of it, I think you'll actually like it, right? Because the I said we're going to look at the GU and the EU chart. Because the charts are at the low end. I'm gonna use the super high time frame. If you look at this chart, right, we came from this level. We pushed all the way down to this bottom, right? At which point we took the liquidity and we started pushing up. We got a 6-month bullish OB. Let me just take it to the 6-month chart. So everything that he's saying fundamentally, the charts are already showing you, right? We have a bullish OB, which is saying that the dollar needs to go lower. So we're going to get a pullback and then we'll push up. This chart is suggesting, look, we could push to this imbalance, right? I mean, it's a huge imbalance. But if we're just looking at pip count, let's just say we push, uh, maybe we look at a 4,000 point increase. I mean, that seems ridiculous. I get it, but our deficit is ridiculous. So what I'm going to do is trade this down, and then I'll get into the long-term buy, and I'll just kind of let the chips fall where they may. I'm going to get more in the indices. Once I get a pullback, the Dow Jones hasn't broken the high yet. I suspect that at some point it will. But once that happens, I need the Dow Jones to pull back because I can't buy it from where it is right now. Okay, the S&P and the Nasdaq already broke this high. The Dow Jones hasn't. So at some point, I expect Dow Jones to break this high. Then I need to pull back. Once it pulls back, I'm going to start trading the indices.
Can I share my chart?
Sure.
Okay, please. Okay. So, I'm on my iPad. I'm sorry. Okay. Oops. Can you see my screen, sir?
Yeah, I can see it.
Hello? Okay. I'm trying to get somewhere where it makes a little bit more sense. Let me go down to the 4 hour. Um, okay, so I agree with you. I don't think that price is going to start selling until it breaks that all-time high, which I have up here, at 45,057. So I see this as corrective movement, and I'm looking for price to either break this previous day low, right, and then buy, or come and grab this liquidity here, or go to this imbalance here. So that's what I'm looking at. But I just wanted your uh perspective, or if anybody else had anything else. And then I have uh I marked up Nas 100 too. So
I think that chart makes sense. Um, can you go to the weekly? Let me see what that weekly candle closed.
you think it was an inside bar on the weekly? Let me see. Mm, no, that was not the weekly. I think it was one time frame that had an inside bar. I can't remember, but it wasn't the weekly. Do I need to hide my drawings?
No, because I think that's about right. Because to me, I think it might pull back into I mean it's an inside bar on the daily, but it might pull back.
Yeah, that's what it was.
Yeah, there's a daily
Yeah,
imbalance below that
that's what I
below that equal lows right there.
that's what I meant. There was an
Yeah,
inside bar here.
yeah.
You talking
So
about here?
yeah, yeah.
Yeah, so this was I go ahead. I'm sorry, sir.
No, I was just saying that that's a likely spot. And maybe not all the way down in that imbalance, but if price goes below where you have equal lows, liquidity grab, then I can see maybe it tapping in and just going higher to break the all-time high.
Okay. All right. So you those spots look okay to you?
I mean, they do. I just, yeah, I, for me, I wouldn't be interested in going long if it doesn't take that liquidity or if it doesn't tap into the imbalance.
You talking about right here?
Yep.
Okay. That was so that was my these are my two spots. Either price breaks the previous day low and then gives me a change of character on like a lower time frame, or
Mhm.
it comes and it grabs this liquidity. I can go to let me go to the 15-minute or something. Or the 30. Mm. So this is where I was looking at. Because this is like would be considered like a demand zone. Um, but right here, I would think where price will come and take this, the which is right by this golden zone, which I had fibbed the 2 hour and I think the 4 hour, like from top to bottom, and it was around this area. So this is not exactly where I'd be looking at. Price would have to come closer for me to kind of decide where I'm going to get in at if price comes all the way down here. But as of now, I'm looking to see how price is going to react off of the previous day low. Because the past couple weeks, it would come grab the previous day low and then just buy the rest of the
You
week.
keep pushing. Yeah.
But again, because this right here, this is here, I'm concerned about this. So I mean, price could come break this and then it would buy from this area. So I would just have to watch price action. But I know that I believe, that all of this is going to get wiped and this is just to induce sellers.
All the what?
all of this corrective movement, I think is going to get
Yeah,
wiped.
no doubt. I agree. Let me see the NASDAQ.
Okay. Mm. So this one I just kind of, let me start from the higher time frame. Mm. That's not what I meant. I gotta pay my subscription. I guess it should be considered inside bar too, but I wasn't really looking at
You
that.
say you
I
guess.
honestly just feel like price.
It is a sidebar.
I mean, yes, it is. It is inside bar, sorry. I wasn't even looking at that. But what I was looking more so is price gonna come grab this previously stay low. There is a 4 hour and a 2 hour golden zone. Let me go there. There's a 4 hour and a 2 hour golden zone right here. So price, I feel like price gonna come break this, come somewhere in this area and buy back up. Or yeah, I don't know.
Hey,
That's what I got right now. Or it's gonna come grab these equal lows. And honestly, this would be a good spot for me because this is an institutional candle right here, an institutional order block, and it's at 9 a.m. So this is, I didn't even see this. If price doesn't, if it just decides to plummet, which I don't think it will, I'd be looking to buy here. But again, I'm open to anything that anybody else may see. Ouch.
I think I don't disagree. I think the if there's a possibility of one of them buying first and then selling, I think it's the Dow Jones. I think in every scenario that I look at, this is just going to go up. You know, like this is rejecting off that order block that it's at right now. Dow Jones went through that first one. So, you know, it is what it is. I think this is a pretty clear um, pullback to buy.
Okay. Well, that's all I have. Mhm.
Appreciate it. Does anybody um, want to share their chart?
Thank you.
Everybody good. Everybody know what they trade.
Seems so.